You probably heard the recent headlines that Bitcoin is back near 120,000. Yes, you've heard it right. And if you're like most investors nearing retirement, you're probably wondering, am I missing out? But adding crypto to your retirement plan is not just as simple as hitting the buy button. You could risk a portion of your future income on one of the most volatile assets out there. I've worked with dozens of retirement portfolios that now strategically include digital assets. And if you're wondering if crypto has a place in your plan, then you're not alone. The rules, the risk, and even the accounts themselves are evolving fast. So in this video, I'm going to show you ways to invest in crypto inside your retirement portfolio. So let's get into it. I'm starting with the foundation because before you even think of buying Bitcoin or Ethereum or whatever coin you're interested in, you need to make sure that you're starting with the right type of account first. And here's where some people will hit their first wall. Think of your retirement account as the container and crypto as the ingredient. You can't bake the cake if you don't have the correct pan. The same idea applies here. You can't just log into your 401k account or your IRA account and toss crypto into the account. Most retirement plans don't actually allow you to do that at this point. But the good news is that there are other ways to hold crypto in retirement. First, there's the self-directed 401k. So if you are self-employed, you can have a solo 401k with the self-directed option, and that can open the door to investing in crypto. It usually allows this through a brokerage window that allows you to step outside the traditional retirement account menu. The Department of Labor backed off of its earlier restrictions in 2022. And since then, there's been slow but steady growth in these types of accounts. The upside is that you get the traditional tax advantages of a 401k. So you've got pre-tax contributions, high contribution limits, and employer match if you have a side business that you can put match in from. The downside is that these setups are still rare and you're going to be limited by what your plan administrator allows. You're also going to need to be more hands-on in structuring it. Now, your second option is a self-directed IRA. So these are going to give you way more control over your investments. With a traditional IRA, you can defer your taxes now and pay them later. And with a Roth, you're able to have that money in there growing tax-free, and you can withdraw that money if certain conditions are met later on without having to pay any taxes or penalties on the growth. But you cannot hold crypto directly in a regular brokerage IRA. You need a self-directed IRA with a custodian that specializes in alternative assets. Once you've chosen your account type, the next big decision is who will hold your assets. Because picking the wrong IRA provider could mean high fees, poor security, or worst of all, losing access to all of your assets. So now I'll break down how to choose your custodian. In traditional finance, you never choose just anyone to hold your stocks. With crypto, it's even more important. So first, you want to make sure that they support crypto inside retirement accounts, not just regular crypto trading. And bonus points if they support both the traditional and a Roth IRA. Also do a little homework. Check their reviews, see if they've ever had a data breach, and see how long they've been operating for. Because longevity matters in a platform where many providers have come and gone. Secondly, they must have serious security protocols. This is a non-negotiable. Look for cold storage, ensured custody, multi-signature access, and a clear handling of private keys. If it feels vague or overhyped, then you should walk away. The third thing is you want to watch for pricing traps. Many platforms charge asset-based fees that scale with your portfolio, slowly eating away your gains over time. So prioritize providers with flat, predictable fees. I'll share a few platforms with you that are the most trusted crypto IRA providers. One is Directed IRA plus Gemini. It offers a flexible structure that allows you to hold assets through an LLC or directly. It's ideal for investors who want more control. Then Alto Crypto IRA is good for Roth IRAs. It offers no setup cost and an intuitive platform, for Roth IRA tax-free growth. And for those who prefer a traditional name, Fidelity Crypto IRA is slowly expanding its access, making it a long-term promising option for crypto investment. Now, before you hit the buy button, let's talk about what you're actually buying, because this can get overwhelming with literally thousands of coins out there. But let's keep it simple and strategic. For most retirement-focused investors, Bitcoin and Ethereum are the go-to options because they're widely adopted and are most likely to have staying power over the next few decades. Bitcoin is viewed as scarce, durable, and a potential hedge against inflation. While Ethereum, on the other hand, fuels a massive ecosystem of apps and smart contracts. And if you're feeling a bit more adventurous, you might consider a small allocation to altcoins like Solana or Cardano. But again, altcoins are like penny stocks. They are high in upside and high in risk. So if you're going this route, consider limiting your exposure to 1% or less and money that you can afford to potentially lose. Now, if managing individual coins feels too technical or intimidating, there is another path. Consider a spot Bitcoin ETF like IBIT, FBTC, or ARKB. These trade like regular ETFs and let you get exposure to Bitcoin through regular brokerage accounts. It's not the same as holding crypto directly, but can be more familiar and regulated on RAM. So no matter what you choose, remember that timing the crypto market is nearly impossible. That's why many investors will choose to dollar cost average. This means that you're investing small amounts regularly over time to help manage the impact of volatility. It's basically a steady approach for long-term retirement planning. And now comes the real question. How much crypto should you actually own? I know it's confusing, but this is where portfolio design makes all the difference. For most retirement investors, the recommended allocation is between 1 and 5% of your total retirement portfolio. It's just enough to benefit from crypto's growth potential without risking your future on a volatile market. For example, start with your base allocation. Let's say it's a 60-40 stock bond mix. So that means that 60% of that overall portfolio is invested in stocks and the other is 40% invested in bonds. Then carve out a slice, let's say 3% for your crypto exposure. Let's say that you have a 500,000 portfolio. If we designate 3% to your crypto exposure, that's approximately $15,000. That is a small wedge. It can potentially boost your returns without throwing off your whole risk profile. Now, if you got a longer runway, let's say another 20 years until retirement, some experts argue that you could even increase that percentage of crypto exposure to 10 or 15%. But that's optional, and that's a high performance model, not the entry level. So start with the basics, adjust over time, and keep your long-term plan in the driver's seat. Remember that investing in crypto in your retirement isn't a set it and forget it plan. It's a living part of your portfolio that needs ongoing care. First, rebalancing is key. So you want to check your portfolio maybe every quarter or at least once every year to see if your crypto exposure has drifted out of range. If it's ballooned to 8% instead of 4%, then it may be time to take some of those gains off of the table and sell a portion of your exposure. That is how you manage risk and lock in gains. Now let's talk about security, because where there's crypto, there are hackers. Make sure your provider offers good insurance and utilizes cold storage. And if you're managing your own keys, then you want to consider a hardware wallet. It's the safest way to self-manage. Just don't skip the basics. Two-factor authentication, secure passwords, and account monitoring are a must. Finally, the crypto landscape is evolving fast. Regulation is shifting, tax rules change, and new investment vehicles hit the market each year. So stay informed, but only through trusted and unbiased sources. Because crypto is dynamic, but with a disciplined strategy, you can keep it working in favor of your retirement plan. Now, if you're 10 years or less from retirement, everything I said still applies to you. It's just that the margin for error is a lot thinner, because at this stage, it's more about preservation and less about big growth. growth plays. This means keeping your crypto exposure modest, between 1 and 2%, and focusing only on the established coins like Bitcoin or Ethereum. No altcoin adventures here. And whatever you do, do not chase. This is not the time to play catch up with risky bets. If your portfolio has a gap, then crypto is not the shortcut. And if you're behind on savings, betting big on crypto is not the solution. It's a gamble. So before you invest a single dollar, ask yourself, if crypto was to fall by 80%, would my retirement plan crumble? If your answer is no, then you need to scale back because risk management is the strategy. It helps to protect your portfolio from losses that could derail your long-term goals. It means knowing your limits, staying diversified, and making sure no single asset, such as something as volatile as crypto, could derail your plans. Let's talk about taxes now, because even inside a retirement account, crypto does not get a free pass. If you're investing through like a traditional IRA or a 401k, any withdrawals that you make are taxed as regular income, just as if it would be if you were just taking money from that type of account and it was a stock or a bond. Anything coming out of those accounts is taxed as regular income. Gains don't get special treatment here. They're taxed when you take the money out. Now, if you are using a Roth IRA, then that is great news since gains are completely tax-free. As long as you meet the qualifications, then any gains that you have in that account, if you're 59 and a half and you've had the account for 5 years, should be tax-free. Another major benefit of keeping your crypto in a retirement account is that you can avoid the complex capital gains and reporting requirements that come along if you have it in just a regular brokerage account or a wallet. So no messy 1099 forms, no worrying about short-term versus long-term gains, just one simple tax treatment on the funds. Before I wrap it up, there's one more piece that most people miss when adding crypto to their retirement plan. And it's not about accounts or taxes, it's about you. Because crypto isn't just financially volatile, it's also emotionally volatile. Unlike stocks, crypto trades 24/7. It doesn't sleep. It doesn't take weekends off, and neither do the headlines. One day, crypto's up 25%, and another day, it's crashing 18%. And social media is just panicking about it. That constant noise messes with your head, especially if you're near retirement. So, what behavioral traps can quietly sabotage your strategy? Well, you should note them. First, there's panic selling. So, say there's a sharp dip that hits the market, and suddenly you're willing to sell everything to try to cut your losses. But historically, crypto rebounds are fast and fierce. Miss just a few key days and you lose out on a massive portion of your long-term upside. Now we've got FOMO, the fear of missing out that drives you to want to get into crypto. So you might see crypto is at all-time highs and you hear influencers flexing about their portfolios online and you think to yourself, I have to get in now. But buying into the hype means that you usually are buying at the top and regret can follow soon after. Another trap is over allocating after a win. So let's say that you started out your crypto exposure at 5% and now it's grown to 8%. And then you decide, well, it's doing so well. Why don't I increase my 5% exposure all the way up to 15? That's performance chasing and not strategic investing. It feels great until it doesn't. And finally, checking prices too often. So when you refresh your portfolio 5 times a day, it can feel like a disaster when the market dips. This is when you stop thinking long-term and start reacting short-term, and that's a problem. So how do you protect yourself from yourself? Start by setting clear allocation limits before you invest. Decide how much crypto belongs in your portfolio, then automate the rebalancing. This helps you prevent to make decisions in the heat of the moment. Also, turn off price alerts and unfollow the hype accounts. Instead, write yourself a simple crypto policy. It should include what you're holding, why you're holding it, and under what circumstances you would adjust and how much you want to hold.
Then set guardrails, not goals. You're not here to beat the market. You're here to build a retirement that lasts. Because the truth is, your biggest risk with crypto may not be the asset itself, but how you respond to it. And remember, discipline beats brilliance every time, so stay disciplined. At the end of the day, crypto can be a powerful tool, but it is not a magic bullet. The key is fitting it intentionally into your bigger retirement strategy, not just chasing headlines. And if you're unsure of what or how much crypto your retirement plan should include, then let's fix that. I help investors like you every week discover how to balance growth, risk, and confidence. So book your one-on-one session with me today, and let's build a retirement plan that fits your goals. The link is given in the description below. See you next time.